Hi, and welcome to Module 10.2, where we're going to talk about depreciation methods. We've already talked about one depreciation method as we talked about our adjusting entries, and we spoke briefly about the general concept of depreciation. Again, typically depreciation is on our long-lived assets over a period of time, and what we're trying to do is account for the wear and tear on those long-lived assets. So, as we recall, we always record our assets at the historic cost, including any costs associated with making it ready for use. And throughout the years, that value is declining based on wear and tear. And so rather than draw down the value of those assets, we accumulate that in what we call depreciation. We recognize that amount every year as it relates to the revenue that that asset has helped us to generate. So in today's lecture, we're going to talk about three different depreciation methods: the straight line, which should be a bit of a review, diminishing balance, and units of production. There's three distinct differences with these different depreciation models, and just like anything, inside of each organization, as we looked at these long-lived assets, we should determine just how the wear and tear occurs and choose the method that best fits with the devaluation of these assets. So the straight line method, it assumes that there's equal depreciation over every year of an asset's useful life. So it means that once we've calculated our annual depreciation rate, it stays the same across the way. So every year we'll recognize the exact same amount. The second method, which is our diminishing balance method, recognizes greater depreciation in earlier years. So we think about some assets that diminish in value early on. We may think about vehicles, for instance, or high technology components, assets with a high level of technology. Again, typically they decrease in value quickly over the first few years before they hit obsolescence. The last method would be our units of production. And units of production recognize depreciation based on actual use. So if we had a vehicle, for instance, we may decide that depreciation should be recognized based on the number of kilometers and not by the number of years that we hold the vehicle. We may also have equipment that we assume that the wear and tear is based on the number of units that are produced or the number of hours that the machine is running. So all of those types of things can factor into our units of production model, and again, we recognize based on the actual use on an ongoing basis. And so year to year, that depreciation might vary depending on our level of use. So let's take a deeper look into each of these three models. So the straight line method, again, typically the most simplest, and we start off with a formula to recognize our depreciation rate. So we're going to take our cost minus our salvage or residual value, those terms are interchangeable, divided by the number of years of useful life, whatever we estimate it's going to be around for. That's going to give us our annual depreciation expense. So again, if we looked at an example, we'd have JJ Limited. They purchased a truck for $10,000. And estimate at the end of its 10-year life, they could sell it for salvage value of $10,000. So we have $100,000 our cost minus our residual or salvage value of $10,000 divided by our number of years useful life of 10. Means that every year over that 10 years, we're going to recognize $9,000 of depreciation expense. In our diminishing balance method, there's a few steps that we have to look at first. We're going to start by determining what we call our straight line rate, which really is just 1 divided by our number of years of useful life. Then we'll multiply that straight line method, or straight line rate, by what we call a multiplier. So sometimes we'll call this the double diminishing balance, which would mean that we multiply by 2. We could have a multiplier of 1, 3, 5, 6. It really depends on the type of asset that we're using. So that multiplier is typically given to us. And so now we have our straight line rate, and so we'll calculate our annual depreciation by taking our cost times our rate and getting our depreciation expense. And step 4 is then we're going to adjust our carrying value and calculate depreciation for the next period. So let's take a look at that in an example. So again, let's look at JJ's truck. This time they use a diminishing balance method with a multiplier of 2, or what we call the double diminishing balance. Okay, so we're going to set up a little table, our year, our carrying cost, our rate, depreciation, and the accumulated depreciation amounts. So let's start by step 1, calculating our rate. So we start by using our rate, 1 divided by our number of years useful life. You recall we assumed that this is going to last us for 10 years, times our multiplier. And then here it says we have a multiplier of 2. So our depreciation rate in this question is 20%. All right, we start by taking our carrying cost. And again, this is solely our cost. We do not use salvage value or residual value in a diminishing balance method. So we'll take our cost times our rate, and we'll get our first year depreciation of $20,000. In year 2, we're going to adjust our carrying cost. So our cost minus the accumulated depreciation. So now we have a carrying cost of $80,000. That's the value that's really on our statement of financial position if we think about it. We have our asset on our books for $100,000 less accumulated depreciation of $20,000 means that the net value of those assets on our books are $80,000. So now we'll take that $80,000, multiply it by our rate of 20%, and our annual depreciation in year 2 is $16,000. And our accumulated depreciation is at $36,000. In year 3, again, we'll start with our cost minus our accumulated depreciation. So now we have a cost base of $64,000 times our 20% depreciation rate. Depreciation in year 3, depreciation expense will be $12,800. And our accumulated depreciation now bumps up to $48,800. So as you'll see, what's happening as we go through time, our depreciation amount is decreasing. So we're recognizing more depreciation in the earlier years and less in the later years. And we could continue this chart all the way down to its 10-year useful life. The third method we'll look at is units of production. So again, for this, we're going to estimate the total usage for the asset's life, and we're going to calculate a rate per use. So in this case, we look at a formula that would look something like this. Our cost minus our salvage value divided by our total estimated use. Example, number of kilometers, number of units, number of machine hours. And that's going to give us our depreciation rate per whatever we decided to use, per kilometer, per machine hour, or per unit. That gives us a depreciation rate, and so then from that point forward, every year all we will do is multiply our actual rate, our actual use, times the depreciation rate to get our depreciation expense. So let's look at JJ now. He expects the truck to last for a total of 360,000 kilometers. In the first year, they drove 80,000 kilometers, and in year 2, they drove 58,000 kilometers. So let's adjust our formula here. Our cost, 100,000 minus our salvage value of 10, divided now by our estimated use for the asset's life, so 360,000 kilometers. That gets a depreciation rate of 25 cents per kilometer. So now every year, to recognize a depreciation expense, we'll simply multiply the actual use times the depreciation rate. So year 1, we drove 80,000 kilometers times our rate of 25 cents, gives us a depreciation expense of $20,000. In year 2, we drove 58,000 kilometers times our rate of 25 cents, gives us $14,500 in depreciation expense. So as you can see, this method is very inconsistent in terms of what our depreciation expense will look like. It's completely variable based on the actual use of whatever we've chosen our rate to be against. So in this case, we use kilometers. Again, we could use machine hours. We could use number of units. We could use any number of variables there. Okay, so those are our 3 depreciation methods. Please take some time to work through our self-assessment problems, and we'll see you all in our weekly tutorial. Thanks so much and have a great day.